The banks, to my corporate doctor stethoscope, are unhealthy all the time. And the fact that they hate equity with this passion is only evidence they have so little of it, too little of it.
I'm Bethany McLean.
Did you ever have a moment of doubt about capitalism and whether greed's a good idea?
And I'm Luigi Zingales.
We have socialism for the very rich, rugged individualism for the poor.
And this is Capitalisn't, a podcast about what is working in capitalism.
First of all, tell me, is there some society you know that doesn't run on greed?
And most importantly, what isn't?
We ought to do better by the people that get left behind. I don't think we should kill the capital system in the process.
So in 1981, the socialist candidate François Mitterrand won the presidential election in France. It was the first time a socialist won the presidency. You know what is the first thing he did? He nationalized all the major banks.
I think I might be able to guess why you're giving us this history lesson, but tell us.
Because I want to discuss how crucial banks have been to the development of the capitalist system and to what extent they might distort capitalism, to what extent they interact even with democracy.
Interesting. We all talked a lot about banking. It was mainstream cocktail party conversation in the wake of the financial crisis, but that seems to have faded, not surprisingly, in the last decade. And even with the SVB collapse, it still didn't quite come back to cocktail party chatter.
So when most of us thinks about bank, especially people of my generation and older, the image that everybody has in their mind is the famous fragment from the movie It's a Wonderful Life.
You're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
While technically the bank in the movie is actually a savings and loan, not a commercial bank, there is one aspect of this story that is still pretty much representative of the banking business today, and another that is not. Question for you, which is which?
I'm not entirely sure. I guess I would say that savings and loans don't exist anymore. Banks are no longer subject to runs because of the FDIC, which was created in the wake of the Great Depression that, banks are supposedly not subject to runs, at least not for small depositors, that insure deposits up to a set amount. So that's a thing that is different today. But I guess something is the same today that we still operate on this system known as fractional reserves, where the bank doesn't have all the money to give back to customers because it's making its money in part by lending out customers deposits in order to make loans.
Both are right, but what I want to emphasize is slightly different. So the first one is that in economics, when we have a model of banking, we always think about banks lending to an entrepreneur. In fact, most of the lending of banks is for real estate. Today's banking, there are $12 trillion of loans, and more than a third of it is just for real estate. And if you think about loans to firms, it's only 1/6 of that. The other big activity is to lend to consumers. This myth that they are the engine of the economy because they support small businesses is true up to a point, is overemphasized. The other thing is that while there was, of course, even at the time of the movie, a Federal Reserve, it just started, and the lender of last resort function was not working as well as afterward. In the case of the Bailey savings and loans, the bank was not insolvent, was illiquid. All the assets were in long-term mortgages. If all the depositors want their money back right away, there is not enough liquidity to pay. However, if the central bank is willing to discount those loans, as the central banks now does, then you can get liquidity as long as you have enough capital or enough assets to support all the deposits.
But isn't the key question sometimes when a bank gets in trouble that it's really difficult to tell the difference between insolvency and illiquidity? Because it can be the fear of insolvency that makes a bank illiquid. And so in order to minimize the risk of either real insolvency or the perception of insolvency that leads to illiquidity, we have bank regulation. I think we have the perfect guest to invite to discuss this, our longtime friend, Stanford professor Anat Admati. She just came out with an updated edition of her 2013 book, which is called The Banker's New Clothes. It's a book about banking and banking regulation that she wrote with Martin Hellwig. And so regulation requires banks to finance at least 6% of their assets with equity. So the core of Anat's argument, or one of the cores of her argument, is that this is just nowhere near enough, and that actually 20 to 30% of a bank's assets should be financed with equity.
Anat has been doing this argument for a long time. A lot of people, me included, at the beginning were more skeptical. As time went by, you see that a lot of other remedies can be very easily sidestepped. And the beauty of that solution is that it's so simple.
I'd love to hear how that changed. In other words, why were people skeptical of her argument from the beginning? And how did some of these other ideas become so fallible, or reveal their fallibility, maybe is a better way of putting it?
I think that financial economists tend to be not interventionists by nature. And so the more reasonable one, which I hope I belong to as a group, are willing to intervene when they see a problem, but are willing to intervene to the specificity of the problem. So, for example, debt is subsidized from a tax point of view. And so why don't you go first and remove the tax subsidization? Let me be very clear to our listeners. There is a tax advantage of debt, which is decided by the federal government, and I think is the first order of business to fix.
Yeah, it's really interesting. I have to admit, I had never thought about the idea that the tax deductibility of debt was problematic. And I love when there, as you know, when there are these things that are structural that we take for granted because they are structural, and then suddenly you think, but why is that so?
So why don't you fix the problem rather than trying to go for a pretty strong intervention? Because is basically like saying, oh, you can open a grocery store, but you can only open a grocery store with 90% equity in your capital structure, which is like a pretty big ask. Now, restated, what a point is taking taxes aside, there is not a real sort of difference in finances with debt and equity, with the provision, however, that it's clear why deposits are a cheaper form of funds, because they benefit from this liquidity service or payment service that we all need. And so deposits are a cheaper source of financing. So banks would like to finance themselves with deposits as much as they can, but then they don't want to insure that deposit with having enough of an equity cushion. So that's a point we stated. And I think that point is right.
So let's bring Anat on and talk to her about her arguments, and then we will circle back and discuss. So, Anat, I think a lot of people tend to think that this issue of how much capital banks should hold was over a long time ago. Even for people in the know, they think it was a discussion post the financial crisis and that we've resolved that and moved on. Yet there was just this hearing in Congress, and the banks, I think, based on what you were saying before we started this podcast, actually have this gigantic lobby called Stop Basel Endgame. So explain what your reaction to the hearing it was and where we are, what's going on.
Well, people around me were saying, oh my God, did you see that hearing? And boy, was I flabbergasted. I mean, right off the top, you were saying that the banks hold how much capital they hold. Already there's a problem right there. So let's explain to your listeners what this is actually about. What it is about the funding mix, funding with debt and equity. That's what it's about. It's about leverage.
Despite zero evidence that U.S. banks are undercapitalized today, the proposed Basel III Endgame rule, 10 years in the making, shockingly, if enacted, would increase capital requirements by about 25% for the largest banks.
So capital is like, they use that word, but it's really kind of equity funding. And how much equity they use versus borrowed money. And borrowed money, debt, is like from deposits, from all kinds of other short-term debt, other things. And they banks have almost very little equity. No other company anywhere lives like that with no regulation. The ranking member, Senator Tim Scott, he says what it is about more capital sitting on the sidelines, he said.
The chairman asked a question about, can you achieve the increased capital requirements? My question is, can you achieve the increased capital requirements without negative consequences to the economy and to lending?
Senator, we do have concerns that some of the items in the proposal will lead us to either increase the price or to reduce the amount that we lend.
What they're going to start saying is, I won't make a loan. If you don't subsidize my funding through subsidizing debt, then I won't make a loan you want me to make. I mean, that's basically what's going on. And I'm going to tell the poor people and the black people and the farmers and everybody else that I won't make them loans. And I'm going to weaponize, I'm going to recruit all of them to say to their senators, stop Basel Endgame because it's going to ruin the American dream. And this came up a number of times in this hearing, that the American dream will be shattered.
The rule would have predictable and harmful outcomes to the economy, markets, business of all sizes, and American households in ways the Federal Reserve has not studied, contemplated, or shared. Mortgages and small business loans will be more expensive and harder to access, particularly for low to moderate income borrowers, as costs for originating and securitizing loans rise.
Oh my God, they can't function. They cannot function. Luigi knows what I'm talking about. You too. That they can't function if they have slightly less leverage. Way before banks were limited liability corporations, they would have to have 50% equity and unlimited liability for the owners, because otherwise people won't trust them with deposits before deposit insurance. So now we're in a world in which, once you get addicted to living like this, then any change in the direction of more equities appears expensive to you as the shareholder, as the manager of the bank. Now, Sherrod Brown, he's the chair of the committee. He says these requirements, they do not stop the banks from making any loans.
Be clear, absolutely nothing in these rules would stop your banks from making loans to working families, to veterans, to homeowners, to small businesses. Absolutely nothing. The reason banks might make fewer of these good loans in the future is the same reason we've been seeing less and less productive banking activity for years. It doesn't make your banks as much money as the risky stuff. You know that, we all know that. You'd rather fund risky trading and derivatives bets than boring bread and butter small business lending. So even with this rule, you can still lend to small businesses and homeowners. You just might not increase your profits quarter over quarter by quite as much as you increased them last year.
And indeed, Sherrod Brown was right saying nothing in these rules stops them from making any loans. Absolutely nothing.
Anat, your proposal with Martin is not to increase by a small amount. You want to increase equity to between 20 and 30% of total assets, when today, in the best case scenario, is probably 6% of risk-weighted assets. And we don't want to go into the details between the difference between one and the other. But not only the bankers, but also a lot of our colleagues claim that this will be very expensive and probably will lead to a recession. So what do you respond to those?
Oh my God. From the first time I started asking, why not 25%? I never got a good answer. And we're talking 15 years. And nobody will tell me what the cost is to society for that. Because all we're talking about between the 5% and the 25% is not that they can't take deposits. 75% is debt. They can have debt. I'm even letting them grow, retain your earnings and grow. What I believe is going to happen to the largest one is they will shrink of their own inefficient weight, because investors will tell them to shrink. I'm subjecting them to market-based stress tests, raise equity. If they cannot raise equity, it's precisely what killed SVB. They couldn't raise equity. They were insolvent. Whatever the equity market will give you, that's much better stress test than what the regulators are doing, okay? Go raise it. Let's see what your business model actually is. Because what we're arguing is the business model in banking is too dependent on subsidies right now. It's not a healthy corporation. So the banks, to my corporate doctor stethoscope, are unhealthy all the time. And the fact that they hate equity with this passion is only evidence they have too little of it. So nobody has ever pointed to me how a recession will actually happen if you have the bank build up their equity. If the industry shrinks and individual institutions shrink, maybe that's a good thing.
Why would that be a good thing? Explain that a little bit more.
Well, because some of them are way too big to be governed. I mean, the size and complexity of these largest institutions that were there in Congress, you don't even have them anywhere so large and so complicated. They couldn't live in markets ever with this shape. They are just too inefficient. The trillions of dollars on balance sheet nothing relative to the off-balance sheet exposures that they have with derivatives and other things that we can't even fathom how complicated they all are. And then they are in all these different countries to the point that they cannot fail. Having an institution that cannot fail without imploding the whole system is not capitalism. That's Capitalisn't. I mean, specifically, that's not markets, So we begin to question whether we even want global banks like that. It's not clear that banking shouldn't be constrained to a jurisdiction where they can fail maybe or regulate it effectively. We know that when there's, global finance, the bankruptcy process doesn't work for those kinds of companies. We are kind of hostages at that point. So the only way to deal with it is to make them, intervene before they fail. And because of the safety net that they have, so many safety nets, they can live like that.
I'm sympathetic to the idea of much higher level of equity in the banking sector. I'm a little bit more worried than you are about the transition phase. In a sense, one of the things that was brilliant in my view of what was done in the recovery phase during the financial crisis was that at some point after the stress test, they said, the government is here ready to give you equity. Either we put equity or you find it in the market. And all of a sudden, the banks found a lot of money in the market, right? Because they were forced. Today, we have to tell to Jamie Dimon, you have to go to a 25% equity tomorrow. Then what it's going to do is try to grow slowly to minimize the pain, which will have impact on the economy. And if you say, do it tomorrow by issuing equity, that will maybe succeed, but will dilute massively the equity holders today, which will cause them to reduce in value, which I know that you don't care, but he's one of those equity holders and he doesn't want to do it. So he's going to fight tooth and nail.
That he doesn't want to do it, we agree. That's for sure. Now, transitions. Retained earnings is the first and obvious step to go. So first, stop the dividends. Now, Warren Buffett doesn't pay dividend. All the tech companies for years and years don't pay dividend. You invest the money. Don't burn it, but invest it even in zero net present value investment. You can invest. So the money still self-insures your deposits. The only issue is who insures your deposits, your shareholders or FDIC. The bottom line is, both of you, there is no logical argument in terms of social cost and benefit. Because if they get subsidized, somebody else is paying that subsidy. And you can take that subsidy, if they get less of it, and give it to whoever it is that they were going to make a loan to or whatever. Because, the American economy doesn't live on credit. It lives on investment. The fact that you are giving people money in debt form is already because our economy is debt-fueled anyway, private debt. So, that's a deeper problem, but we can go there. Small businesses, other people may not be able to fund anything without debt, but corporations can, and so can banks, because they are corporations.
So just on a basic level, I don't understand how shrinking the banking system wouldn't cause the economy to shrink, given that the banking system, that the provision of credit is the backbone of economic growth. So it seems to me that you shrink one, you shrink the other. And then a follow-up on that based on something you just said, how do you take that subsidy and give it to somebody else? I mean, that sounds nice in theory, but how is that actually doable?
First of all, you're the one who wrote a lot on private markets. And right now, there's no problem for anybody to give credit on any money. It doesn't have to be.
I was getting there. We're coming back to the private markets.
It doesn't have to be. We're going to go there. Shadow banking and all these other scares. You can lend. You can give credit using any money, not just deposit money. The initiation of mortgages or small business lending on a JP Morgan Chase balance sheet, it's virtually nothing. I mean, it's not what they do. It's like they say, that, Harvard is like an endowment with the university on the side. JP Morgan Chase is a hedge fund with a little bank on the side, except that the bank gives them $2.5 trillion of play money, okay? With investors walking in the door and giving them the money and not having any collateral or contract, just deposit insurance, okay? $2.5 trillion. That's a nice start. But it's not true that the banks are the quaint institution that they invoke in you from the, It's a Wonderful Life. That's not the current institutions. And so there's plenty of other people who make loans with all kinds of money. And that's fine with me. the shadow lenders, mortgage lenders. So if you take your private credit markets and all the other lenders, the non-bank lenders for the mortgages, which, Amit Zero and some other colleagues showed actually have 25% equity or at least, they have twice as much as the banks that are not funded with deposits that are there. There are tons of mortgage lenders. So already the banks are not doing it. Already it's going someplace else. And they show you that it's fine. I'm not scared of the shadow banking system per se. Most of the time when you go to the shadow banking system, which is like a money market fund, you find the banks. Because the money market fund ran on the bank, the investors ran on the money market fund. So you just have more layers of intermediation. That's the problem, is throughout this system, where the end borrower is and where the final lender is, the person who finally invests in 15 layers of intermediation, who knows?
So one thing you and I have discussed before where we disagree a little bit, I think you have more faith in the shadow banking system than I do. And you cited the examples of mortgages, but that's something that had to be bailed out in the pandemic. Just as Fannie Mae and Freddie Mac had to be bailed out back in the global financial crisis, the whole system of financing homeownership had to be bailed out in the pandemic because instead of making it more stable, we've moved it entirely to the shadow banking system where mortgages are originated by these companies that, yes, may have 25% equity, but then they're held in so-called REITs or mortgage REITs, which engage in the whole lending long, borrowing short fiasco. And they started to collapse in the pandemic and had to be bailed out, or the whole homeownership market would have ground to a stop. So why is that better than a bank?
I'm not saying it's better. I'm saying that the entire system is poorly regulated. That includes the shadow banking. I think we ended up agreeing on that. The point being that you create institutions in the shadow banking that are completely intertwined with the regular system. And you have to look at the whole system and see how to regulate all that's going on down the pipe.
So in 2010, when President Obama signed the Dodd-Frank Act, said because of this law, the American people will never again be asked to foot the bill for Wall Street mistakes. There will be no more tax-funded bailouts, period. And I don't know how many minutes of applause follow that statement.
2 minutes. I counted 2 minutes. 2 full minutes.
Now, did Obama and the subsequent president, particularly his former vice president, maintain that promise or not?
Oh, definitely not. Oh, there's no question about it. I mean, and we just saw the evidence because there are bailouts happening as we speak. SVB was a bailout. First Republic was a bailout in the sense that a bailout is where you have initial people who made a contract and somebody prevents the default. So it's the existing banks that are bailing out the failed banks or the creditors of the failed banks. That's a bailout in my world, okay? Whoever is the customers or the shareholders of the surviving banks paying for this. Now, the large banks have so much implicit guarantees in the sense that they raise money so cheaply. They'll cross-subsidize the rest of the sector because their subsidies are unbounded from the implicit guarantees, the fact that they will never fail and therefore they can always raise money from investors or depositors or somebody. And look at Credit Suisse. I mean, that was despite all their promises that we got some clever debt that will convert to equity, and it didn't. They blinked and they provided supports. The FDIC now is, bearing losses with JP Morgan Chase. They allowed banks that have more than 10% of deposits against the rules, giving them exemptions to have more. FDIC right now stopped imposing any losses on depositors, no matter insured or uninsured. So we have effectively unbounded deposit insurance. And that is very, very dangerous because that's exactly what happened in the savings and loan, in the sense that insolvent institutions go to investors and say, it's government guarantee, give me deposits and I'll pay you high interest. And you do that until they're run into the ground.
So backing up to before these bailouts to the pandemic, there's an argument, the conventional line of thinking is that look at how well the big banks held up in the pandemic. We fixed them with the new capital requirements coming out of the financial crisis. Why do you not agree with that line of thinking?
I don't agree with that because the banks benefited from every support that was given to the entire economy. Without the support to everybody else, it's not clear how they would have done. They benefited every which way. The Fed is buying corporate bonds. There's an investment banking business to do. Everybody was raising equity. People who are not defaulting on loans because there were all these forgiveness programs. Think of the PPP program. All of that indirectly help the banks. They were just standing there collecting fees, doing nothing, bearing no risk. They were borrowing at 0.25%, lending at 1%, getting fees, and the 1% loans were either forgiven or guaranteed by the government. So they were just sitting there collecting billions of dollars in fees and interest gaps, spreads, for doing nothing, for giving it to whoever they wanted, including large corporations that it wasn't even meant for.
So today, when I take my money and deposit at Citigroup, I get 3 basis points. For the listener, is 0.003%. So basically nothing. Now, if Citigroup takes that money and deposit at the Federal Reserve, it gets 5.4%. So takes no risk, nothing. Now, the question is, why can't I, individual, put my money at the Fed? I can get 5.4%. I would love to get that. And by the way, there's no risk at the Fed, so it's risk-free. So why is this system in place, and why this is not a major subsidy to our banks?
It's an excellent question, Luigi. Why are only the banks getting cheap funding or interest on reserve? Why isn't everybody getting interest on reserve? So this interest on reserve, we do discuss it in the book. It's a big windfall, and I agree with you. They don't pass it on. All of us are getting virtually no interest. I found myself now, because I was actually a depositor in First Republic, having just moved my money from Wells Fargo, getting no interest from JP Morgan Chase right now. It's bad, and I completely agree with you. They have so many ways to make money, and this is one of them. Just interest on reserves, literally. Paying us nothing and getting interest from the Fed.
There are some colleagues, and some actually are my colleagues at the University of Chicago, who think that having too much equity is bad, that you actually need to keep banks on a short leash, because otherwise this generates agency problems, so that banks are fragile by design.
So when we wrote the book in the first edition in 2013, we spent a lot of time writing a chapter about does fragility discipline banker or debt discipline bankers, okay? Which I heard your colleagues say in one debate with me, that it keeps them on the straight and narrow, fragility. But the fact of the matter is, when there's a run, that's already when they're insolvent. There's no evidence that the manager was somehow afraid of the run. In fact, the banks were very reckless with all this leverage before the crisis. So where is the evidence that the leverage created discipline? So that's just a story on a piece of paper. I'll tell you that when we wrote the fallacies paper, I had a banker read the whole paper. Somebody from banking, 40 years in banking. And he said to me, why did you have this long 10-page section about debt discipline? Is this some kind of an academic thing? This is what he said. Like, he wouldn't even think of it, okay? This is a practitioner in banking, okay? If that was disciplining, why don't we hear anybody from the industry wanting better governance like that? That's not what they ever say. It's an academic story. So when he asked me, is this an academic thing? I said, yeah. And unfortunately, we have to debunk it, because academics are reverse engineering what we see as they got a clever story for why that's a good thing. And that's the name of the game in academia, is the reverse engineering of we see it must be good. The world must solve some problem. I'm going to reverse engineer a problem that is solved this way. But I have an alternative explanation of why we see high leverage. And it's not that it's efficient. It's despite it being inefficient.
So you mentioned the phrase academic myth, but I'm confused. Aren't all academics like you and Luigi brilliant, well-intentioned practitioners of their science? How can there be an academic myth? How can there be somebody who might be maybe invested in supporting the banks? Could that be?
No. Look, there are different reasons. When I asked a colleague here why they still say these things, I was told they love their models. Now, I love my models. They are my children. But I don't take them seriously to the real world, where I look out the window and I know that my explanation is not the explanation. We have to be able to reject a model based on casual empiricism. It's not like there's no data to show that, that disciplines bankers. Never, ever. You can't even disprove it. In fact, if you take some of these models, some of them, the way they're written, are not actually about banks. You could apply them to other corporations, and then you ask, so why don't we see the leverage in other corporations if that's how to govern?
A last question from me, which gets to the last chapter of your book. What does our inability to deal appropriately with banks tell us about democracy's ability to confront the power of corporations?
Oh, I think it's very alarming. After the financial crisis, I can, right at the moment, I am very disappointed with Michael Lewis because of his latest book. But in any case, in The Big Short, which we cite extensively, he ends the book with saying the problem started with banking when the partnerships became corporations, going public, raising money, growing as they did, okay? And that's when the risk became a black box, and that's where the people whose money was put at risk lost control over it, okay? And then he says, the problem was not that Lehman Brothers was allowed to fail. The problem was Lehman Brothers had been allowed to succeed, which is exactly what we are saying.
So, Anat, you were definitely a pioneer in finance, even more so, if I may say, as a woman in your generation. I actually did not do a proper study, but I would say that you're probably the most cited woman who never got elected president of the American Financial Association. So do you feel you're being discriminated more as a woman or because of your ideas?
I think it's both. I also have a style that I challenge people and they don't like it. I know of all kinds of things people say behind backs. I have a lot of stories which I can tell you with academics that would be very disturbing, even without mentioning names. But, over a glass of wine, I'll mention names. I made peace with the fact that I am not in these crowds and that these crowds exclude me. And I have experiences today of people specifically not responding to emails and because we picked up an argument with some paper sometime. I can tell you that people in high policy positions would not engage. Now, I don't know if they would have engaged with a man saying what I say. They just didn't want to hear it. They just didn't want to hear it. They went to people who were who were telling the narratives that they wanted. I just have to do what I have to do, and it ended up being more important to me to speak truth than to belong to those clubs.
Excellent. Thank you, Anat.
Thank you, Anat.
Thank you. Bye.
If you're enjoying the discussions we're having on this program, there's another University of Chicago Podcast Network show you should check out. It's called The Pie. Economists are always talking about the pie, how it grows and shrinks, how it's sliced, and who gets the biggest share. Join veteran NPR host Tess Vigland as she talks with leading economists about their cutting-edge research and the key events of the day. Hear how the economic pie is at the heart of issues like the aftermath of a global pandemic, jobs, energy policy, and so much more.
So, Luigi, you mentioned before we brought Anat on that people have come around to her point of view. I can't tell, actually, either what you think of her point of view about banks needing to hold far more equity, nor do I know where her ideas sit within the economics profession now. I think it's still pretty controversial. But what's your view?
So my view is I warm up to it as the benefit of simplicity and a lot of other mechanisms that could be done. They tend to be clever or cleverer, but more subject to lobbying pressure and being undone. She's a bit too cavalier on the transition. I think it can be really dangerous in terms of slowing down the economy. I think that actually something like what happened in the financial crisis, say you need to move up, and if you don't move up, we inject equity, additionally with a restriction of no dividend and restriction on executive pay. All of a sudden, bankers will raise a lot of equity. So I think that is doable, but it requires a very strong willpower, and I don't see any government willing to do that.
I definitely can subscribe to her argument that this idea of these global banking behemoths is not necessary. At least my cursory understanding of the history of financial regulation is that the U.S. felt like we had to copy Europe's banks or we were going to get left behind. And Europe's banks have turned into lumbering, incompetent zombies, basically. So I'm not really sure that the argument that we had to copy them was right. But I don't understand how we go from where we are to a very different model of banking without some kind of economic disruption. And maybe that's just your transition point. But I guess I'm trying to get my arms around this idea that if banks lend less, doesn't that shrink the economy? Isn't there a core of truth to that? Or am I just missing the mark?
No. It's not that banks will necessarily lend less. In the transitional phase, if they are allowed to accumulate equity in other ways, for example, by retaining earnings or investing less aggressively, etc., they will do that because issuing equity in the short term might be painful for the equity holders, and because the managers tend to be large equity holders, directly or indirectly, they might be unwilling to do that. So the only way in which, paradoxically, the transition will not be so costly is if you point a gun to their head and say you raise equity or we inject equity, and then the problem is solved. But that's where I say I don't see any democratic government being able to do that. And so then there would be this transitional phase. In this transitional phase, they will, of course, play a lot of games. And so I think that there will be a slowdown in the economy in the transition. So the transition to a model is rather unrealistic. However, I think it's incredibly useful to have her position out there because it's very provocative and forces people to rethink. And Martin and her are doing an excellent job at poking fun of all the people who provides non-theoretically sounded reasons for why equity is more expensive. So
I also loved her point. It was a little bit of a smaller point, but I really loved her point that this idea that it was important for banks to be highly levered because that created fragility, which then enforced a form of discipline, that no banker has thought that ever, that comes purely from academia as a way of sort of being a lapdog to the banks in a really strange and interesting kind of way. But that made me laugh. I don't know if it made you laugh as well.
No, maybe I'm too much in the academic world. I think that we academics do have theories that practitioners don't recognize as valid. That doesn't necessarily mean they're not valid. I think in this case, I'm more with her than against her. But I think that the fact that bankers don't recognize, I don't think is the ultimate litmus test.
Okay, fine, fair. I just like to poke fun at you economists. You know, you poke lots of fun at journalists, so I get to take my pound of flesh when I can. One thing she also said on the podcast that I really liked, that I have not heard her say perhaps as clearly, and I don't think is as clearly stated in the book, is that we really do need to look at the whole financial system, because one of the things that came out loud and clear to me in reporting on our financial system for my book on the pandemic is that the whole thing is fragile, and shockingly fragile in all these weird places, because it's a financial system that has been cobbled together over time, and we've tried to sort of patchwork fix pieces of it through regulation, but without ever stepping back and looking at the whole and saying, does this financial system serve consumers and businesses as effectively as it can? Because that's the point of a financial system, right? Is to finance consumers and businesses. And where does risk get driven? And I liked that she acknowledged that the shadow banking system can be as problematic as the banking system, because I think we've sort of, out of laziness or something in the decades since the financial crisis, where the shadow banking system has just mushroomed, kind of forgotten about that, as if it's outside the regulated banking system, then we don't have to care about it. When the reality is, come a crisis, we always have to care about it, even if it's outside the regulated banking system.
You're absolutely right. But I have to say that what really took me a bit by surprise is the unwritten story that at some point she will write, which is a personal story. It's difficult to be a contrarian. Particularly in her generation, it was difficult to be a woman, but it's particularly difficult to be the combination of the two. And you pay a cost, and she did pay a cost, but she was willing to take it. So I think that eventually there will be a very interesting memoir book.
I think so too. She is a truth teller. That is for sure.
Capitalisn't is a podcast from the University of Chicago Podcast Network and the Stiegler Center in collaboration with the Chicago Booth Review. Also, check out promarket.org, a publication of the Stiegler Center. The show is produced by me, Matt Hodap, and Lita Cesarine, with production assistance from Utsav Gandhi, Sebastian Burka, and Brooke Fox. Don't forget to subscribe and leave a review wherever you get your podcasts.